S&P 500 closes at a new yearly high. Nasdaq reverses off a key level. Semiconductor index gets above major support. Small spec index positions and what it means. Smart money, dumb money confidence spread at one of the widest gaps we've seen since 2011. How we can benefit from it. Target rate probabilities for the July Fed meeting. Apple stock making all-time highs. NVIDIA's massive rebound. AVGO setting up all-time highs. Bitcoin setting up to break out despite the recent SEC comments. Specialty retailers such as Ferrari are breaking out to all-time highs. We're going to explain why and how to benefit from it. We have a ton to go over. Let's get to it. Hey everybody, welcome back. So we're going to start with the basics. We're going to just start with the S&P and what happened. You can see the clear break here and out, right? So we start here from the August and then we're here. And we can see why this would be such an important level, right? We can see that higher high and how that was been rejected over and over again. We couldn't even get up to it. We actually started developing this minor, which actually turned into a major level around 4,200. But we pushed through, finally through. Then we get this little reversal. And now we have what we would refer to as a bullish engulfing, which completely encapsulates that past week and is setting us up. Couple really very simple things, yet very important things that I think you need to look at. Number one, here's your volume on the breakout. Here's your volume on the red week, which is non-existent. Now look at your volume going into this week. Okay, it's actually stronger. So the selling volume you saw last week was basically non-existent. Now this week we had pension funds that were selling. They have to rebalance. We went over that in a previous video. We have some window dressing that obviously happened on Friday. We can get into that a little bit. But the bottom line is, you're setting up to break out. We've been talking about this for some time, about how we could pull back, and the pullback that we were looking for was roughly around 4%, and it could be a little shallower based upon some of the things that we saw out there, like the cumulative AD line, and we'll get into that in a bit. But our next level here that we're looking for is going to be that 4685, 4700 level. I think you're really looking up in this area. And I don't see any reason why we're not going to get there. People looking at this chart and suggesting that somehow it looks like it's going to roll back over. Again, I see there's nothing technical that would state that. Nothing that you could look at that could justify that. You could argue from some kind of economic standpoint that things are really bad, but I don't see it that way. As a matter of fact, I actually see GDP getting stronger, and I'll explain why in a moment here, and then people are going to say that's inflationary. It's not inflationary if prices are coming down. It's just growth, right? There's a huge difference here. People are kind of missing that. So you saw that Friday's PCE. So you can see here again, left shoulder, head, right shoulder. We've gone over this before. Is it perfect? No, but nothing in life usually is. And then you can kind of see how we tried to break that here, right? And then failed. You never got the rejection through. And then we push through and you get confirmation here. So this is an inverse head and shoulders, no matter how you want to look at it. At least it is to me. I'm just going to clean that up for a minute. Just again, be Captain Obvious. What you want to do with these is you just measure the neckline. That pretty much tells you everything you need to know. So you go to the top of the head and the inverse, and then you go, okay, that's 20%. So from that, if you're just we're speaking truly technically, you're looking at 20%. Okay, that's what that move's telling you. Now let's be real clear about this. Okay, that doesn't happen in a week. It usually takes a very long period of time. It usually takes the length of this base, right? So just again, to be super technical, what you're doing is you would take that baseline. Okay, so that took you 52 bars or took you a year to get there. So what I'm suggesting is not out of the realm of possibility. What I'm suggesting is, let's say from that neckline to get to 20%, if that took a year, would that really be crazy? And the answer is no, right? Nobody would think that's completely out of line for us to get up there in the course of a year. I mean, you have a lot of bears out there, and I don't know, again, everyone's entitled to their opinion, but I'd be really careful who you listen to now. So that would be 12% in 12 months, 1% a month. I don't think that's absolutely insane. And I do think that it could even heat up. But this measured move, that alone is telling you that that's where you're going. It is literally impossible for anyone that does any level of technical analysis or any proficient level of technical analysis to look at this and say, this is going lower. Could something fundamentally or macroly shift Absolutely. Could there be something else out there? Absolutely. We had the Russian Civil War that lasted 24 hours. Right? We don't know. We never know what's truly going to happen, right? All we can do is set up what we think is going to happen and then go from there. I think they made your life very easy with giving you a minor support right here at 43.6475. Chances of breaking that, if you break that, you're probably going to come back down to this 4,200 level and retest again. I don't know what the chances of breaking that without something coming out and being way off what we think it is. So keep that in mind. We are fortunate enough that we have monthly charts that we can kind of look through right now because the end of the month is here. And I'm just going to clean this all off and start again. So if you look at that, what's happening? Well, we're getting above the 50, right, on the RSI. Volume, how's volume going for the month? It looks to me like you have 4 months of nothing but buying, right? 4 months, but nothing but buying while we kept hearing to wait for the end of the world. And the reason I keep hammering that home is because I saw this in 2003. I saw this in 2011 when we were trading them. And what winds up happening is people just think that because they missed it, that, oh, it's got to pull back. It becomes an ego thing. And you have to be real careful of that. That's a clean breakout. And there's nothing there at all that's telling you that you're going to have any issues. Maybe you could argue, oh, we're going to stop there. Okay, well, that's 4,600. That's another 5%. You could get there in a month. Right? These are not hard levels to get through anymore, right? The hard work's done once you're over this 50 line, and especially on the monthly. I mean, you can even see it here, right? I mean, you can basically set your watch to it if you really wanted to. I mean, it's pretty clear, right? When you start looking at this, it's amazing how glaring some of this stuff truly becomes, especially when you just go back in history. And the reason you look at history is not because it's going to be exact, but because it gives you an understanding of what happened before, and maybe that will happen again. You know, they always say in those mutual funds, you know, past performance is no indication of future performance. It's very true, but that's all we have. So we have to deal with what we have. And that's it. I mean, it's really that simple. So I'm going to start with the Nasdaq monthly since we're already here. And we're just going to take a real quick look at this. You can see that level right there, how you're setting up to pull out. And then just go through this on the monthly again. 1, 2, 3, 4. So I've got 4 months of buying, right? Well, everybody's waiting for the sky to fall. And I don't see any reason at all why you're not getting back up to here. Zero. People are grossly underestimating this entire AI move. And they're not getting it, and they're thinking that it's based upon the consumer. It's not. It's going to be based upon the corporation and the fact that the corporation is going to have to implement this in order to compete with other corporations. Okay, that's why I get so adamant about this. And to me, this was nothing but a trap to get people to sell. And I think it worked out pretty perfectly. And tried to convince a bunch of people that they were right, and for about 5 to 6 days. You know, and now they have an issue, and it's becoming increasingly clear with the PCE. Now, we talked about this pullback about 2 weeks ago and said that we'd be looking for about a 4% pullback. Nasdaq pulled back about 4%, and the S&P, you can go back 2 weeks and watch that video if you like, and we'll explain why we came up with that number and walk through it as well. But I just think it helps to look at this and just go, okay, well, what happened here? 2.7% was the pullback. So we were talking between 1 to 4%, and that it usually happens within 1 to 30 days of the day that we set it. We just happened to get lucky and have it happen on day 1, so we were aware of it. I think you have to look at that and say, okay, yep, that's washed itself out. You can see how the RSI has completely worked that off and how we're lifting higher. And I think that's a really important distinction. So if we look at the indexes in and of themselves, it's almost impossible to look at these and to say that things don't look very good. Now, those will remember from 2 weeks ago that we talked about this. This is the cumulative AD line. In other words, they add cumulatively to the move as we continue to push higher. It's not just a straight line that just says advanced decline this day. It's cumulative. It builds upon itself, which is great for when you're trending up and trending down because it becomes very clear what's happening. For example, you can see here how we just kept going lower and lower and lower, trying to build, right? And then you can start seeing the lower lows, and you can start taking advantage of this and understanding when you're going to have washouts. But more importantly for me, when you start seeing this hitting all-time highs, and people are talking about the market pulling back, that's very, very hard to understand how you're thinking that. In other words, the market's getting stronger. Cumulatively, if we go back and just take a look at this over 20 years, we're at all-time highs, 15, 10, 5, 3, 1. So when you start looking at it from that perspective, the cumulative AD line is hitting all-time highs. We are broadening out into all these different sectors, which we're about to go over. And at the same time, we have naysayers out there saying, oh, well, we clearly have to pull back because we have inflation. PCE is clearly showing that inflation is at bay. I don't know what else people are going to want to see to wrap their heads around that. But it's very clear that inflation is at bay at this point. Just very quickly, for those that aren't aware, PCE came out yesterday. And these are the numbers. I'm just going to use this on investing.com. It's a free site. Anybody can go to it. But if you look at core PCE, which is without food and energy, you came in line month over month. Year over year, it dropped. Year over year, index as a whole plummeted. PCE price index plummeted month over month. At the same time, personal income, which I really don't watch that much, actually upticked. Personal spending was down a little bit. Then you just kind of come into Chicago PMI, 44, and you're at 41.5. So just so we're clear, anything under 45 is contraction. And what we're seeing is we're seeing manufacturing contract to a pretty substantial level, and we're seeing the pricing and inflation plummet, not drop, plummet, right? This was our forecast. This is where we came in at. PCE was supposed to come in at 0.5. We came in at 0.1. Okay. And this is including energy, food, everything. Core takes it out. So I think this is a really important distinction. And for some reason, I think it got lost on a bunch of people. And I'll explain what I mean by that. This is CME Fed tool. And what's really important about this is the following. They're stating that in July 26th, we have an 86.8% chance of them raising rates. You can see the hike right here. I think that this is grossly over-exaggerated. I'm not saying that he's not going to raise rates. What I'm saying is the probability of this raise is not it's not predictive of what we're actually seeing happen in the market. And I'll show you what I mean by that. But the best way I can explain it is if I'm looking at this 87%, well, that means everybody would just be buying the short end and not be buying the long end of the bond market, right? Well, that's not what they're doing. In front of us is the 10-year bond. And the reason I'm pointing at this one is I think this is pretty glaring stuff. Okay, so here we are at 8:30 in the morning when PCE is released. And look at what happens. They just buy bonds, right? That's all they're doing because the yield drops, right? So the bond yield drops 1.3% within about a half hour. That's how fast people were buying bonds after that PCE release. Okay, they're buying the long end. We're going to take a look at the 20-year in a moment here. And then you go and take a look and go, well, how did we do when Chicago PMI came out at 10 o'clock? Okay, well, we couldn't even rally, and all they did was buy more bonds. So from there, you dropped 1.25%. So they are buying bonds on the long end. Now, if we take a look at this and go take a look at TLT, and you just look at this on a 1 minute, and obviously this is bond price, we'll get rid of this, versus bond yield, which we were just looking at. But you take a look at this and you go, okay, well, what happened during the day? All we did was buy the 20-year all day long. Well, if you think they're going to kind of raise rates, right, over and over again, why are you buying the 20-year? Just to be clear about this, retail cannot move the bond market. Okay, it is not the guy buying the 20-year treasury from his Robinhood account that is moving this. This is institutional and commercial hedging. And this is what they're doing. And meanwhile, we have the world saying there's an 86% chance that we're going to be in a position that we're going to raise rates in 25 days. I would argue that you just think about what's going to happen to the equity markets if they don't raise rates in July. I would seriously think that that is a much greater possibility than the 14% that we're being told. That's my argument. Not that they're not going to do it, but the chances of it are substantially less than 86%. One of the key areas that a lot of people are not looking at is they're not looking at retail. And I'm not talking about the Targets of the world. But when you start seeing these kinds of breakouts, consolidation, pullback, and for purposes, just so everybody's aware, I use a 12, a 22, and a 55. You should use whatever you find comfortable. So when you see these pullbacks, retests, and now you have these breakouts, right? You have to pay attention to that. And one of the things I always do is I always look at what we're doing in the room, and I always look at the alerts, and then I see if I can put them together, is there some kind of theme? And the one theme that I'm noticing that is happening is that we are seeing massive money flow into certain names, and nobody's talking about it. No one at all. So we started buying this around 280 and change. We're at 325 now. 340 was my target at the time. Candidly, right now, I'm looking at this upper channel level right here, and I think we have this is from the newsletter. If you don't get the newsletter, there is a free version below. I'd make sure you click on it to look at the 20 charts I'm about to print out this week. So it'll be in the comments and in the description. So if you take a look at this, right, and just measure the upper channel, right now we're at 370. So maybe you don't want to be that guy that's buying it all the way up here because you're so far off of these levels now, right? But when you start thinking about like when this pull back, and it will pull back, everything pulls back, you might want to start looking at these names. Okay, I mean, Ferrari for us was a pretty easy layup of a trade. We had a clean breakout. You have a 2-year backlog of product, and nobody can get a car. I mean, no one. They have to come out with new models, right? They're doing everything right. So this will probably continue, but it's not just that car maker. So this was another one that we bought, and we're about $15 or 15% in already. And here again, it's these specialty, what I refer to as specialty high-end companies that just consistently put out a high-end product that people want, right? And I think that that's being missed a lot by the market as, geez, why is this moving or why is that moving? Doesn't make sense. You take a look at Alta. Alta was something we bought at 440, and now we're back to 470 already, and this is setting up again after you're coming off that bounce. People were foaming at the mouth to buy this at 200, but they weren't able to. The stock pulls back to a major support, and everybody forgets about it, right? And all it's done over the past 4 weeks is start to reclaim. We just looked for a way in and found it. And I would focus on that. I would focus on that high-end stuff. And Alta, yeah, it is expensive there to go and buy your materials or whatever. They go there and they go there and buy. But you should be thinking about it from that perspective. The other one, and I'm not saying that it's moving up because it's not going to do something AI and everything else, but this is a high-end retailer. If you have an Apple phone, that is a high-end product. And what you're seeing here, for me, and what I think is really pertinent about this is, what are we going to do here? We're going to just say that we're not breaking out of a multi-year base. This was something we bought at like 180. We're about $14 in it now. And you look at this, and it's clear as day. But this is also a high-end product, right, that consistently sells. Another one, and people aren't really thinking about it this way, is Tesla. It's the same exact thing. You have a high-end product. If I clean off all these drawings, and for a second here, let me just show you this. But you have a high-end product, and out of that high-end product, people want it, and they're spending money on it, right? They're getting jobs. Those jobs are paying. And just so we're clear, if that's not a bad thing that people are getting to keep their job, right? It's not a bad thing that continuing claims is coming down. It's actually good and shows that GDP is going to spur, and it shows the probability of a recession is actually less, which is what Goldman said about 2-3 weeks ago, but for some reason you just didn't get a lot of coverage. They dropped it. I think they started at 40%. They're down to 20% now, or 25%, the chances of that happening. And I don't see it. I don't see any way that you could be looking at this market and expecting this massive recession. I just don't see what people are seeing. You can't have both sides. I'll just say that. You can't say, oh, we're going to have this huge inflation and we're going to have a recession. It just doesn't work that way. So if you take a look at this and you see how we're coming across, right, you're unable to break. Well, if I do break out of here, where are we going? Well, we're probably going back to this level, right? 300. I would not sleep on this, and I would not sleep on this theme that we're seeing. One of the things I do in the way that I trade when I start doing longer term trading, which you should be thinking that you could do longer term trading now, is I look for themes. When you find those themes, it's very easy to find which names are going to make money. And right now it's very clear that they are buying these names that are, quote, high-end retailers. We can call Apple a technology company all we want, and it is, but it's a high-end retailer. And that's it. You go to a retail store, you buy something there, right? You go online, you buy a product, okay? Same exact thing. I would be focused on these kinds of names. To look at Apple and think that you missed that move, and if you just, I'll go here a second, clean this all off, to think that you missed this is absolutely laughable. Right? I mean, we could sit here, we could measure the size of the base just like we did before on the others and just go, okay, well, what's the size of the base? Okay, well, roughly 30%, right? I mean, anybody looking at this that can do just the most minimum of technical analysis can see how they got to that 240 target price at Citigroup, right? I mean, they tell you they don't look at charts. They look at charts. So Citi comes out with a 240 target. Look where it puts you. It's right there. So that's how he's looking at it right now. And this is what, week 2 that you're above, and you're going to think that you missed it because you didn't buy it down here. You're going to have to change your thinking if you are bearish and you miss things. You're going to have to understand that what you just went through is probably a bear trap on that pullback, and that this is what we're dealing with now. And there are signs that the economy is actually going to get better, not worse. This is a graph by Sentiment Trader. And you can see their symbol right here, and they got the information from the Department of Labor. It's always important that you understand what you're looking at and where you get the data from so that you can make a more informed decision. You might look at this and completely disagree with me. So continuing jobless claims from 52-week highs, which is right here, to a 16-week low. Okay, this is what is called a buy trigger, right? So you go from a 15-week high to a 16-week low. And you can see continuing claims, they're dropping, right? So people are able to find jobs. The economy's holding up. Inflation pressures are coming down. Is it possible that we have this, quote, soft landing? The probability of it is getting greater and greater, despite, what the pundits are saying. But usually those pundits are the same people that were, submarine experts about 2 weeks ago and now are experts on Russian affairs. So why is this important? Well, it's important because of this. Now, jobless claims trigger a bullish signal for stocks. Continuing jobless claims cycled from 52-week high to a 16-week low, triggering a bullish signal for stocks. Similar reversals preceded excellent returns for the S&P 500 and cyclical stocks over medium and long-term horizons. We just went over retail names. We just went over them 2 seconds ago, right? So fits perfectly right into what they're saying there at Sentiment Trader. The improvement in employment tends to lift the ISM manufacturing survey. The improvements in employment tend to lift the ISM manufacturing survey. Okay, so now we understand why cyclical names could be moving, because continuing claims is dropping because people are getting jobs, right? That's not a bad thing. And it's one of the things that's always fascinated me is why people, want the employment and jobless claims to tick up. We don't. What you want is more supply. You don't want to increase less demand, just increase supply, right? It's Econ 101. So I really think you have to take a look at it from that perspective, right? So now we understand that where jobless claims are, but I think there's also an important distinction here. As goes ISM, PMI, and you blend manufacturing and services together, what that will do for you is that's going to spur the economy. And as that spurs the economy, you're going to see some names really start to lift. So one of the key things I would focus on is this. I think this is really important. I'm going to clean all this off. And this is the Nasdaq divided by the S&P. Now, what this is going to tell us is just what's going on out there, right? And we really don't need an RSI. And what do I mean by that? Well, if you take a look at this, that's the high that we were at in 21. We're nowhere near that on a relative basis. What's been going on, and I showed this in last week's video, and again, you want to subscribe to this channel if you're interested in actionable information, things that you can actually act on. So, and the reason I say it that way is a lot of the channels that I've noticed that people have brought to my attention, it's a lot of esoteric stuff. I try to focus on things that you can actually implement. So if that's helpful, instead of more of the broader based stuff, just please comment below. I'm always interested in your comments because it helps me create content. So if you see how you're trading in here, right, you can see that level. And this is the Nasdaq divided by the S&P, which gives us a relative performance. And we look at that and go, okay, well, broke down, boom. Okay, well, we're forming a flag. Well, what's this saying? Well, you're about to have more outperformance. But before you have more outperformance, you could still go sideways here. And if we go sideways here, then we're going to want to be in those other sectors, right? It's very difficult for me to look at this and not expect us to go higher. It's very difficult to look at XLF holding here right, which is the financials holding that key level, watching JP Morgan pass their stress test and break out of a 52-week high, and people are negative about the market, right? If you missed it and you missed the pullback, you got trapped, and it's okay. You got to shake it off and move on with your life. I mean, that's the crux here, and I think that's one of the key things people are missing. It's really hard to look at that and not think positively about it, in my opinion anyway. So when I look at this, I'm very comfortable with JP Morgan and what I see going on there, and it means a lot for the market if this is stronger. And you're seeing a lot of signs of that, where the market as a whole is definitely getting stronger. But the names that I think are going to be the big drivers, I do think they're going to still be your IT or your tech names. People forget the building blocks, those IT names. So I'd go through, I'd look at the holdings there. I'd look at what's in there. You're going to have Dell Computer, right? Look what's going on with Dell. Nobody's talking about that, right? No one. Oracle. Nobody's really talking about this. Okay, this is still an enormous move, and we bounced right off that 22. All these names are going to be pivotal. CRM, I like long term, but I'm not crazy about how it's acting in here. I think there's better names. I think everyone's leaning towards Pan right now. And I think you saw that on Friday. And another quick tip that you can do, go look at the last 10 minutes of trading on window dressing in the market. It'll tell you everything that they're buying. You can go take a look and see what did they feel the need that they had to show their limited partners that they're in, right? The most glaring was Apple. I mean, just look at the spike, right? They had to show that they owned Apple by the end of the day for their books, because you had all the window dressing on Friday, as we went through in a previous video. But I think if you look at that and go, okay, well, that's the theme, the IT, well, what's driving all that? Well, AI is going to drive all that, whether you like it or not, right? Whether I like it or not, that's going to be the driver. And it's not so that you and I can go on board and say, draw me what I would look like in medieval times. It's so that people can utilize this technology to make their businesses more efficient. Now, Stanley Druckenmiller had a really good statement, and it was very eye-opening on how big this is going to be. So developers that have been using AI technology are now 7 to 8 times more productive than they were 6 months ago. That's an enormous level of productivity. And if you think that corporations are not going to want to know how they can get more productivity out of their clients, out of their employees, you're crazy. Like, of course they do. Why wouldn't they? It lessens everything. And it makes them more productive, and it increases their operating margin. So of course they're going to do that. So here we are with NVIDIA, and we can see this coming straight across, and we can see exactly how we're acting. And this is not, to me, it's not pretty. I don't like a lot of wicks like that, but it's there and it's holding, right? I wish I almost closed at the high, got some kind of dragonfly pattern here. It's not pretty. And there's some things here that I'm not really crazy about. I'm not really crazy about the fact that, I'm holding here. I'd like this to turn. If I crack there, I have a real issue. I am pointing up, and I pointed this out about a week ago. Or yeah, I guess it was about a week ago, and I pointed this out, and I'll clean up these lines so we could talk about it and say it. But this is something that we do own in the Alpha Chasers community. But I pointed out this level and said, well, kind of have a level there, and you can always clone these. You can do this on any trading system. It's not hard. And the reason to do that is because you want the same trajectory. Because if you can find the same trajectory, then what you can get is you can get a sense of it. Wicks are what? Price rejection. So you can see that sitting in there, right? Okay, so now I've got this rising wedge. It doesn't really make me feel warm and fuzzy. I mean, look, I have a position in it. I see no reason to get out of it. Being super technical, looking at that, it does not make me feel great. I like that I held the 22. I like that I came back to it. Just a reminder, I use a 12, a 22, and a 55. You should use whatever you're comfortable with. So you can just also see how the RSI is turning there. I do use RSI a lot in my charting. The reason I do is it's one of the only leading indicators out there. One of the other ones that I use is the cloud, that Ichimoku cloud, but it's very complicated to explain to people. So I did a video on it a long time ago, but I like that a lot. I like anything that's a leading indicator, right? That can actually tell me something. Not even just determining price, just give me an edge, right? So you're looking at names like Pan. These things look great. I mean, I don't really see any real issues there. You talk about names like Overstock. This is one that I really just did not understand exactly what they were doing when they were trying to buy these assets, and then the court approval of those assets and the changing of their name, whether you like them or not, is sickly brilliant. You have millions of people that want to shop at Bed Bath & Beyond. I know that the people that are watching this video might not be that target audience, but you have a group of people that want to shop there. They love their coupons. They like going there, buying their scented candles, and now it's been taken from them. Well, Overstock's going to give that back to them. So they are going to do quite well. I mean, picture owning a company and not having to pay any of the employees or any of the overheads of the brick and mortar stores. I mean, it's a game changer. It's really a game changer. And I keep trying to find a way in. I traded it the other day. I made $1 or $2 on 2 like day trades, but I really want to get in there. So this is definitely on my list. It's very hard to look at this and not want to be involved in that. I should just drop this in with some vol so you can just kind of see what's going on. I mean, that's insane, right? So you start going through this and going, like the one day, I think it was the most volume it's had in 10 years. And the second, right, you have this February 22nd date. And then what do you have? You have to go all the way to pandemic, and the pandemic doesn't even have this kind of volume on the weekly. So now you're at what? Are you anywhere near anything? Yeah, you're not even near it. You're not even near it. So now you come back and you're saying, okay, well, 22, and then maybe during the pandemic, maybe in here. No, it wasn't even the pandemic where it happened. It was before the pandemic, 19. So you have the third highest weekly volume that you've ever had. And if we go back and say, okay, well, what happened here? Well, you ran up and then we petered out, ran up, petered out. So your antenna's got to go up, right? What's different this time? Anything? You could make the argument that this time we had a declining 9 on the weekly. Again, I don't tend to use that on those kinds of charts. I might use it for a demarcation line. I tend to use something more like this to want to see what's really going on. And when I start flipping like a 55 on a weekly, you have my attention. Now I'm paying attention to it, because what I do is I'll go back and say, well, if I broke it and then flipped it for the first time, and it's inclining, what's happening? Well, I mean, I have the same exact setup here. I'm not saying you're going to go through this, but you have to kind of look at this, right? And say, well, this is where the 12 and the 22 crossed, and this is where the 55 popped. Well, this is where the 12 and the 22 crossed, and this is where it popped over the 55. So you kind of have to look at that, right? I mean, that makes sense, doesn't it? So just something to think about. And I would not rule this name out at all. It would definitely be on my radar. Now, I do want to go through and talk about Bitcoin. I find their timing, the SEC's timing, to come out and say that we find your ETFs inadequate. And then everybody changes and goes to coin, right? I find that interesting because they didn't tell GBTC that they found their filing inadequate. What they said to GBTC was no, and that was it, and forced them to go to court. So while we had this knee-jerk reaction, which we saw a lot of people just sheer panic and get out of these like micro strategies, you can just see these moves like, oh, we have to get out right away. Okay, no, that cost you 20 points. I have a position in this, just disclosure. So the reason I'm bringing this up is you have to think about this. You have to think it through. Well, why would you issue that statement? What is the purpose of you issuing that statement? You've never issued a statement like that before, right? So you have this appellate court that's coming up on GBT. Maybe that's why. Maybe they know that they're going to lose. Maybe he's hedging himself some way. I don't know, but I find it very odd that on Friday you decided to come out and feel the need to make that statement. And I also think it's very interesting that the market completely shrugged it off. When it finally got a hold of the statement, saw the issues, it shrugged it off. And everything went back up. Now, coin to me, I'm not crazy about the name here, but you have to respect what's happening here. And this is definitely something that should be on our radar right now. I mean that as it's on my radar to watch as a trade, possibly. But I don't like the company long term with the SEC hanging over their head. I do find it interesting that all these companies that want to do ETFs are flocking to them. Now, I do want to go through smart money, dumb money, confidence, and just give an update. I think this is really important. Again, we don't call this dumb money. We don't call this smart money. We call this institutions, and we call this retail. And right down here, you can see how oversold we are on, quote, smart money or institutions, and where we are with retail up here. Well, who's winning and who's losing, right? As institutions sell and get out of position, market's going higher. Right? The goal is to make money, right? The goal is not to be right. The goal is to make money. There's a huge difference in those two statements. So you go back and you just say, well, when was the last time that we were this wide? Well, the last time you were this wide, was November 2022. Well, how'd we do? Well, we did pretty well there, right? And I'm not talking about the width when smart money is fully invested, right? I'm talking about the breadth of this confidence and how wide it is when you're in this position. You see, when you start looking at this stuff and understanding what it is, you can start utilizing the data to make more informed decisions, right? So when you start looking at that and going, well, that's pretty impressive. Okay, well, then you go out and look 10 years and you can start finding them and go, well, how did we act there? Well, we acted fairly good for about a year, and you just keep going through them. I found this one in 09, and as clearly it's the bottom, and you did nothing but go higher from there. And then you just look at these times when it happens, and all you're doing is putting in bottoms. Here we are in 2012, right? So when you start going through this and you start really digging into this data, that's where you can start creating an edge. Now, for me, looking at this, I think eventually this market will get back together. I think that they'll come close and come back together to some level. To what level, to what end, I'm not really sure yet. But I would not sleep on things like this, especially when you have a cumulative AD line. Now you have to ask yourself, how long are institutions going to be able to stay out of their positions and net short? This is a graph we've been watching for about a month now. Small spec index positions. Look at where we were. Look at these levels, right? And this is how net short, small speculators, hedge funds under 20 billion are. We're near pandemic levels, right? And you start looking at this and going, you're still not even over the zero line. They're not even net long the market yet. They're not even net long, right? So so they're finally getting it together and starting to put the pieces together, but they're not even there. You're still net short the S&P. Like, you're net short the S&P during one of the greatest moves that the S&P has had since the 90s, right? If you go back and take a look at this period in time, it's 1995 and 1983 meshed together. And a lot of people are just not getting it yet, and they will in about a year. But I really think you have to look at this and go, well, what other time in history were we this net short on institutions? And it doesn't exist. It's actually worse than the pandemic. They're going to have to buy stocks or they're going to lose their job. It's really that simple. Nobody wants to hear that the market's wrong. They want to hear, why aren't you in Apple? Why aren't you in Ferrari? Why aren't you in Elf? They don't need to be in the high beta names, but they need to make money for their clients. We're seeing names like AVGO that are in this space, and they're just hanging in there, and they're doing absolutely amazing. Right to that 22. Again, I use a 12, a 22, and a 55. You should use whatever you're comfortable with. Now, if you look at these levels and you watch how we're hanging in here, very little to say, right? The problem with these kinds of names for me is that they're super thin in their trading, so you have to be careful. But when you take a step back and you look at that on a weekly, I mean, anybody's going to want to own that. Anybody. And this is the kind of stuff that you're seeing happen over and over again. We did have some weakness in some of the software names this week, and I would pay attention to that. But candidly, all we're doing is just rotating. And I like the idea of the rotation because it keeps us in these names. And that's really the name of the game. Home builders. That's your weekly chart on home builders. We keep talking about this housing crisis. We've been talking about this for 6 months. And at least 6 months we've been talking about this, and we've been trading these names. If you look at something like that, you're going to say that it's over. Housing prices just started to uptick for the past couple months after 18 months of being down, which means that people are going to start putting their houses on the market, which means they're going to move, which means they're probably going to buy more new construction properties, which means that Lowe's, Home Depot, and those names are going to start moving higher. I don't know if anybody saw that data in that chart that came out that shows that housing prices are lifting. I'll just show you very quickly here. Let's put this on. There we go. And let's clean this up too for a moment. Blow this up so that we can say it. So if you look here, this is the national home price growth, and you can see how here's your zero line. And now you can start seeing how we're starting to get housing and how housing is starting to move higher in pricing. That might be something to think about if you're looking at the home builders and trying to figure out why they're moving up, right? You're not collapsing despite what everybody's saying, right? And what are you doing? From here on, you've been going higher. And I think that's a very important distinction and one that we should be paying attention to. Now, if we just take a quick look at this bull bear indicator right here, this is from Bank of America. I'm just going to do this in a quick screenshot here for time purposes, but here's extremely bearish, here's extremely bearish, here's extremely bullish. And the purpose of this, the purpose of this, and me showing you this, is that everyone's out there saying, oh, well, extreme greed, extreme fear. Is it? Okay, according to Bank of America Global Research, no, it's not. According to someone else like CNN, oh, we're at extreme greed. You're nowhere near that. And it's very difficult for people to say that they're at extreme greed when you're watching small speculators still carry net short positions on the S&P. So keep that in mind. Clean that off. So when we look at home builders, the question is, okay, what do we do next? Well, if the prices are going to rise, then the names that they're going to move into are the ones that fix up their houses. So I've been very apprehensive to get involved in Home Depot. Lowe's had a fireside chat this week. We talked about this if you're in the community. They did that at Oppenheimer this week, and you could see how the stock acted pretty nicely off of that $10. And the reason that I'm bringing this up is you're going to fix your house up. If you're going to sell your house, you're going to fix it up. So now you're going to either stay in your house because you have a 3% mortgage that everyone's wearing as a badge of honor, or you're going to sell your house. And if you're going to sell your house, you're going to spruce it up a little bit by maybe that new bathroom, those new countertops, things along those lines. I think that's a very important distinction that you need to be aware of. Now, if we take a look at XLY versus XLP, and everybody knows this chart as what? Wants versus needs, right? Your wants versus your needs. What's happening here, right? Ferrari, Elf, Alta, okay? People are selling the Cloroxes and they're buying their wants. And I think that's very important for us to understand. Now, once we get that concept down, we can understand why the money's flowing where it's flowing, right? We have continuing claims that are dropping, right? That's important to note. Then they're going out and they're buying more of what they want. Well, if they're buying more than what they want and prices are still dropping, again, I don't understand the inflationary part of the argument, and I don't understand the recessionary part of the argument. It doesn't make sense to me at all. And if you go and take a look at PCE and what happened, people bought bonds. Traders bought bonds. They didn't sell bonds on that data, despite what the Fed tool was telling us. So I would focus on these names, and I think this is a great place to start. That's it.